We've been through some challenging times together, you and this network, as we try to address global issues. This is one where there's not an easy edge. I mean, what does the playbook look like from your standpoint right now?
Yeah, thanks, Carl. I think the way I look at stocks is very simple. I go, what's your risk reward at any point in time? And so there are certain things we know for certain. Number one, we know for certain that the markets are at record valuations. And my favorite measure is I take the valuation of the entire stock market and I divide it by GDP. And so if you look at that, you're at about 1.5 times, which is exactly where the market was in the late 90s when you had the tech bubble. And the second thing you know for certain is that EPS is coming down and global growth is slowing. So you put those two things together, and for me, that's why we tweeted out on, Monday, February 10th, that we were starting to short Apple and their suppliers. And on February 17th, we put out that we'd ramp those shorts to 50% of our total assets. So for us, it's about risk reward. And with record valuations and earnings coming down, there's no, that's very unbalanced at those levels. And it still is. I mean, we're all sitting here talking about the markets, but don't forget, the Nasdaq's still up year to date. That makes absolutely no sense to me. And the S&P is barely down less than 1% year to date. That makes no sense either, especially when you look at oil and copper and gold and all these other asset classes that are really worried about growth.
All right, so but be more specific. He's selling everything? I mean, is there no secular story that you think you would want to own for 10 years that it might be at a discount today?
Yeah, no, I mean, I think there's a couple of stories that actually benefit from the current environment. So if you sit back and you think about it, you've got a lot of people in China locked down. Now you've got people in Italy locked down. And so you don't have very much you can do other than, watch TV or play games or entertain yourself. So for us, we actually like a couple of the names in China. Tencent, we own that one. We own NetEase. These are companies that allow gaming. And, Tencent's had their servers actually go down several times because there's so many people trying to get online and play video games. We also bought recently, after the quarters were reported, we bought Activision and we bought Take-Two off sort of the same theme. And so, yeah, there are certain spots where we say, okay, this is obviously horrible, but, what things can you put in on the long side that you think might actually do pretty well? And so those are areas that we're looking at, and some of the streaming stuff, too, is kind of interesting as well, though you've got some challenges around the advertising, et cetera. But, yeah, from our perspective, our fund's sitting in 10% cash, over 10%, I should say. And, it'll probably be even bigger at some point. And the market, until it gets to be a point where we feel like people are truly appreciating the risk, we have no desire to step in. Nothing was oversold yesterday. I mean, everybody's talking about how much the market was down, but nothing was oversold.
Dan, just to go back to your point about year-to-date performance for averages like the Nasdaq and the S&P right now, I mean, we've had a number of people on our air who have said, given what we're seeing in the Treasury market right now, I mean, just today, the 10-year at the yield at an all-time low, that makes equities much more attractive. You don't agree?
Absolutely not. The markets are, the equity markets, well, okay, there's two different ways you can think about it. You can say, oh, great, that makes equities a lot more attractive because bond yields are really low. But the thing is, bond yields are really low for a reason. The markets are worried about growth. And ultimately, at the end of the day, eventually, whenever that is, stocks trade off of earnings. And so if you think earnings are going to go a lot lower than where they are today, you should not be sitting there saying, well, at record high valuations, I think stocks make a lot of sense.
So, Dan, what do you think is most at risk in the coming rationalization that you're expecting? What type of stock?
Well, I think, John, that's a really good question. I mean, for me, what concerns me about today is looking at MasterCard, right? Because for right now, everybody's saying, oh, we've got problems with manufacturing in China and, et cetera. I mean, I look at what MasterCard had to say, which is they said, look, our cross-border growth is really slowing down. This is not necessarily related to China. This is more of a broader view of what's going on with the environment. And that's what could really worry people, because going into, these problems with the virus, global GDP growth was not that great. I mean, it was 2.9%. You know, the S&P earnings growth last year in 2019 was 1%. And so all the stock gains were driven by multiple expansion. China's GDP in the fourth quarter, before the virus hit, it was the lowest in 29 years. So to your question, you know, the cross-border trade, global GDP growth, that's the kind of stuff that I'm watching most closely because, you know, stocks could go down 20% to get back to fair value. And that's the stuff that concerns me right now. And investors have developed some really bad habits of thinking every dip's a buying opportunity because the central banks keep stimulating and the multiples keep going higher, offsetting the fact that earnings just aren't there.